All right, let's dive into the world of dividend investing. Today, we're dissecting smart investors. Keep it simple. Creating passive income with dividend stocks, an audiobook narrated by Bob Palmer.
Okay.
It seems to be geared towards beginner investors, promising to make this whole idea of getting passive income from dividend stocks a lot less, well, intimidating.
Sounds interesting.
It does. So our mission today is to figure out if dividend investing really lives up to all the hype.
Yeah,
And of course, arm you with the knowledge to make your own smart decisions about your portfolio.
makes sense.
The audiobook starts by suggesting that a ton of millionaires and billionaires actually park their money in these dividend stocks.
Right.
Which, of course, makes you wonder, is there something to this? Or is it just like clever marketing?
Well, it definitely piques your curiosity.
Totally. So before we get too deep, let's break down the basics. What exactly are dividends?
Well, essentially, think of dividends as a share of a company's profits that gets paid out to the shareholders, the people who own the stock.
So it's like getting a little reward just for owning a piece of that company.
Exactly. And to really show off the power of dividends, the audiobook uses this really cool analogy, the snowball effect.
Okay, I like analogies.
So picture this, a tiny snowball rolling down a hill. As it rolls, it picks up more and more snow, right?
Right, getting bigger.
Exactly, getting bigger and bigger, gaining momentum. Dividends, especially when you reinvest them, can work kind of the same way. Those small, regular investments can compound over time.
So like even if you start small, those dividends can really snowball into something impressive over time.
Exactly, and it all comes down to that consistency.
This makes so much more sense now. Love that visual.
Yeah.
But before we all get caught up in this snowball excitement, we got to talk about the less glamorous side, the taxes.
Right.
The audiobook does mention that different types of dividends get taxed differently.
Yes, important to keep that in mind.
So definitely something to factor in as you're exploring this whole dividend thing. But now, onto a bolder claim. The book argues that dividend income is actually more reliable than capital gains,
Yeah.
especially during those, market downturns. Is there any truth to that?
Well, there's definitely a degree of stability you can find with dividend-paying companies, especially during those rough market patches.
Okay, but nothing's completely risk-free, right?
That's true. But the audiobook gives this interesting example. Coca-Cola, remember the last recession? While so many companies were struggling, cutting back, Coca-Cola kept paying dividends.
Okay.
And get this, they even increased their payouts during that time.
Hold on, really?
Yeah.
They increased during a recession.
Yep. Kind of highlights how resilient these dividend-paying companies can be.
That's pretty impressive.
Right. It shows that they have the financial strength, the confidence in their future to keep those dividends flowing even when things get tough.
Okay, I'm starting to see the appeal here. But, got to be honest, whenever I hear talk about the stock market, I get a little lost in all the jargon. The audiobook kind of throws around terms like stock exchanges and ticker symbols and market capitalization, and I'm just like,
It's like a whole different language, isn't it?
Right.
Let me break it down a bit. So stock exchanges are essentially the marketplaces where those stocks are bought and sold. The audiobook focuses on the U.S., so think NYSE, the New York Stock Exchange, or the NASDAQ.
Okay.
Then you have ticker symbols. Think of them like nicknames for companies is how we track them. Like Apple is AAPL. Makes it easier than saying the whole name every time.
Makes sense. And what about market cap?
Right, market cap, short
Yeah.
for market capitalization.
Yeah.
Basically, it's the total value of all of a company's outstanding shares.
Got it. It's funny, the book mentions this little tidbit about how trading floors used to be these crazy, chaotic places, like straight out of that movie, trading places.
Yeah, I remember reading that.
So different from today, where you can just buy and sell stocks with a few taps on your phone.
Right. It's wild to think how much has changed.
Yeah, from shouting matches on the floor to quiet clicks on a screen.
But even with all the tech advancements, it's still those human decisions, those global events that really drive the market.
Speaking of events, global or otherwise, let's get a bit real here. The audiobook doesn't shy away from those stock market crashes. 1929, the dot-com bubble bursting, and of course the 2008 financial crisis.
Heavy stuff.
Yeah, can be kind of scary, especially if you're just dipping your toes into investing. The audiobook uses PepsiCo during the 2008 housing crisis as an example. They not only survived, but kept paying dividends.
Right.
Showed some serious resilience. But did most dividend stocks hold up as well as the book suggests?
That's the million-dollar question, right? While they focus on the positives, it's super important to remember that not every company, not every sector reacts to market downturns the same way.
So while dividend stocks might offer some stability, we can't assume they're completely crash-proof.
Exactly. Understanding those past crashes, seeing what happened, it helps us look at risk and investment strategy in a new light.
Right.
Like, what kind of companies are built to handle a crisis? How do we build a portfolio that balances reward and risk?
Big questions.
Yeah.
Because ultimately it comes down to making smart choices for your financial goals and your risk tolerance.
Yeah.
All right, so let's say we're intrigued by this dividend potential. How do we actually find these so-called golden geese of the stock market?
Well, the audiobook lays out a pretty clear roadmap. First, they emphasize looking beyond just the dividend yield, how much you're getting back.
Okay.
Instead, focus on consistency.
Consistency.
Yeah. Look for companies with a proven history of sharing those profits with their shareholders.
So it's not about a quick payout. It's about finding those reliable long-term players.
Yeah.
Got it. What else?
Next, dig into those financials. Look at things like revenue growth, profit margins, earnings per share. Are they growing? Profitable, managing their debt responsibly.
Sounds like some serious financial detective work.
Right. We're looking for healthy, sustainable businesses, not just a flashy dividend.
Makes sense. And then there's the concept of a moat, right?
Ah, yes. The moat, like those protective barriers around a medieval castle.
I was going to say.
Think of it this way. It's what sets a company apart, what defends its market share and keeps those profits coming in. Could be a powerful brand, unique technology, a loyal customer base.
Okay, so it's like a competitive shield helping a company stay ahead of the game.
Exactly. And finding those strong moats, that's what separates the long-term winners from the short-term flashes in the pan.
Makes so much more sense now. But where do you even find the information to evaluate all of this?
The audiobook encourages us to do our own research, and luckily there are tons of resources available.
Like,
Well, they mention websites like Morningstar, Yahoo Finance. They're great starting points. They give you all sorts of data, financial reports, even dividend histories for tons of companies.
so it's about becoming an informed investor, not just blindly following advice, which I like.
Exactly. Take control of your own decisions.
That's what this whole deep dive is about. Not just summarizing a book, but really understanding the concepts, seeing how they apply to our own investment goals. So let's say we've found a few companies that check all our boxes.
Okay.
How do we know if it's actually a good deal, a good time to buy?
That's where valuation comes in. The audiobook emphasizes the price-to-earnings ratio, the PE ratio.
Okay, that one always throws me off.
I'd imagine two lemonade stands, both making the same profit, okay,
Right.
but one stand is selling for $50 and the other is selling for $100.
I go for the $50 one. Same lemonade, better price.
Exactly. That's kind of how the PE ratio works. A lower PE generally means you're getting more earnings for your buck.
So it's about finding those undervalued gems.
Exactly. And understanding this metric can really help you buy smart, potentially snagging those stocks at a discount. But the audiobook warns against relying on the PE ratio alone.
Right, got to look at the bigger picture. The company, its competition, how it might grow in the future.
It's all about combining those numbers, the PE ratio and all that, with a good sense of the company's strengths and weaknesses.
A bit of art and a bit of science then.
I like that.
So we've done our research, checked the financials, even factored in that PE ratio, ready to buy, right?
Almost. We haven't talked about knowing when to sell. Even the best companies can hit a snag. Changes in leadership, the industry shifts.
So we can't just buy and forget it. Got to keep an eye on things, be ready to sell if we need to.
Right. The audiobook outlines some red flags. Dividend cuts. Big changes to the business model that might affect those dividend payouts.
So we need to stay informed and know when it might be time to move on, even if it's tough to say goodbye to a company you like.
It's about making sure your investments still align with your goals.
Okay, I'm feeling way more confident about this whole dividend thing.
Good.
Oh, and the audiobook actually breaks down a specific company as a potential investment. The Hershey Company.
Hershey. That's interesting.
Right. Chocolate. Who doesn't love chocolate? Plus, it's a great example to see how everything we've talked about actually applies in the real world.
I'm curious to hear more about that.
Me too. So let's dive into those financials and see if Hershey truly is a sweet deal for dividend investors.
All right, let's do it.
Okay, so we've got the theory down, but how do we actually get started with this whole dividend investing thing?
Well, the audiobook walks us through setting up a brokerage account, which is kind of like your gateway to the stock market.
Makes sense. Do they have any recommendations on choosing a broker?
They do. They seem to really like those discount brokers.
Discount brokers.
Yeah, they specifically mentioned TradeKing as an example, highlighting features like low commission fees, a user-friendly interface, and something called a DRI.
A drip. Like drip coffee.
Huh? Not quite. DRI stands for Dividend Reinvestment Plan.
Okay, what's that all about?
Think of it like that snowball effect, but on autopilot. That automatically reinvests those dividends back into the same company, buying more shares.
Ah, so your dividends are buying more dividends.
Exactly. It's like a compounding machine.
I like the sound of that. Now, the book also mentions different types of brokerage accounts. Traditional IRAs, Roth IRAs. Kind of overwhelming, honestly.
Yeah, it can be. The best choice really depends on your personal financial goals, your current tax situation, your retirement plans.
Right. Everyone's different.
The audiobook gives a good overview, but it's always best to chat with a financial advisor to figure out what's right for you.
Personalized advice is key. Okay, so brokerage account set up. We've done our research, found a company we love, and we're ready to buy our first stock. How does the actual buying process work?
The audiobook makes it sound surprisingly simple. You go to the trading section of your account, you specify if you're buying or selling, enter the number of shares you want, type in the company's ticker symbol, and then you choose your order type.
Order type. Okay, that sounds a bit more complicated than just clicking buy.
It's not too bad. They explain different types of orders, starting with the most basic, a market order.
Okay, what's that?
Basically, it executes your order immediately at the current market price. So you're guaranteed to get your shares, but the price might fluctuate a bit from what you saw when you placed the order.
Got it. So market orders are for those who want to jump in quickly. What if you want more control over the price you're paying?
Then you might consider a limit order.
Okay.
This lets you set a specific price you're willing to buy or sell at, so your order will only execute if the stock hits that price.
So it's like setting a price target and waiting for the market to come to you.
Exactly.
I like that. Any other order types worth knowing?
They also mention stop orders, which act kind of like a safety net. You set a price below the current market price, and if the stock drops to that level, your order triggers a sale automatically. Helps limit potential losses.
So a risk management tool.
Smart.
Anything else?
Oh yeah, they also talk about stop limit orders. It's like a combo of a stop order and a limit order. Your order will only trigger if the stock drops below your stop price, and it'll only execute at or above your chosen limit price.
Wow, there's more strategy to this than I thought. So it's not just picking a company and clicking buy. It's about choosing the right order type, too.
Right, it can make a big difference.
Speaking of selling, the audiobook makes it sound as easy as buying. Is it really that simple?
Pretty much. You just choose sell instead of buy, specify the shares you want to sell, and set your price.
Okay.
But they really emphasize understanding those tax implications, especially if you're using a regular brokerage account and you've made a profit.
Right, taxes. Gotta love them. One thing I found interesting in the audiobook was their take on those more traditional savings options like savings accounts and CDs.
Yeah, they're not big fans, are they?
Not really. They argue that these options, while seemingly safe, often don't even keep up with inflation.
Right, so even though your money isn't losing value, it's not really growing either.
It's losing buying power.
Exactly. Your money is worth less over time. They're pretty critical of mutual funds, too.
Oh yeah, why is that?
They point out those high fees that can eat into your returns and the lack of control you have over the individual investments within the fund.
So they're basically arguing that even with the risks, actively managing your own portfolio of dividend stocks can potentially outperform those more passive options.
That seems to be their main point, yes.
They also challenge that popular 4% rule for retirement income.
The 4% rule.
Yeah, you know, that guideline suggesting retirees can safely withdraw 4% of their savings each year.
Oh, right. What do they say about it?
Well, they argue that it can be risky during market downturns because you might be forced to sell your investments at a loss to cover your expenses.
I see. So with dividend stocks, you're generating income without having to sell.
Exactly, which can be a big advantage when the market's volatile. Okay, so we're sold on the idea of dividend investing. We're ready to start building our portfolio. But how do we actually find those diamond-in-the-rough dividend-paying companies?
That's where fundamental analysis comes in. They stress looking beyond just the dividend yield.
Beyond the yield.
Yeah, you got to dig into the financials, those statements, and really assess the company's overall health and its potential for growth.
Okay, so it's not just about chasing the highest dividend. It's about finding those companies with solid foundations.
Exactly. They start by emphasizing consistent revenue and earnings growth.
Consistent, got it.
Is the company gaining market share? Are those profits increasing year over year? These are key signs of a healthy, growing business.
So we're looking for upward trends, not just a snapshot in time.
Right. They use real-world examples like Fastenal, a company that distributes industrial and construction supplies,
Okay.
and Estee Lauder, the beauty giant. Both have shown really impressive growth over time.
So they're not just talking the talk, they're walking the walk.
Yeah.
Using companies with proven track records.
Right. And they're also honest about companies that have faced challenges.
Oh, like who?
They mention Sprint and American Airlines, companies that have seen some tough times, declining revenues, even net losses.
Right, so even profitable companies can stumble. It's about acknowledging that not every investment is a guaranteed winner. But how do you assess if a company has a truly sustainable model, one that can handle market ups and downs?
The audiobook keeps coming back to this idea of competitive advantage, that moat we were talking about earlier.
Right, the castle walls.
Exactly. Think of companies like Colgate, the toothpaste king, or Johnson & Johnson with all their household and healthcare products. They've built these strong moats that have kept them profitable for, decades.
Okay, so it's not just about a good product, it's about having that edge that keeps you ahead of the competition.
Right. And the audiobook also stresses looking at the management team. Are they responsible? Do they have a history of buying back their own stock, which can increase the value of the remaining shares? And what about their debt levels? Are they manageable?
So many factors to consider.
It's not just about the numbers, it's about understanding the company as a whole. They even encourage diving into those annual reports.
Annual reports, those can be pretty dense. Do they offer any guidance for those of us who aren't, financial experts?
They do. They suggest using online resources like Yahoo Finance, MSN Money, Morningstar. They can help you access and understand those reports without needing a degree in accounting.
That's reassuring.
They really break it down, highlighting the key parts to focus on, explaining the lingo.
So you're saying we can actually decipher those reports without feeling completely lost?
Exactly. It's about learning those key metrics that reveal a company's profitability, debt levels, overall financial stability.
Okay, so we found our company, consistent growth, strong competitive advantage, good management. We've even tackled the annual report. Now we're ready to figure out the price, right?
Yes. Back to valuation. Remember the PE ratio, our lemonade stand analogy.
Rotor PE, better deal. Got it. They suggest looking for companies trading at a PE of 15 or less, especially during those market dips when prices are more attractive. But again, there's no magic number that works for every company.
Right. Each situation is unique. Exactly. You got to consider the company, its industry, its growth potential, everything. And they walk us through a case study of Hershey, applying all these principles to a real-world company.
Back to the chocolate. I was wondering when we'd circle back to that.
They break down Hershey's brand strength, its global presence, its consistent growth, profit margins, manageable debt, and that impressive dividend growth rate.
Sounds promising.
They conclude that Hershey, even though its PE ratio might be a bit higher than their ideal target, has a lot going for it.
So they're willing to bend the rules a bit for a company with such a solid track record and, product everyone loves.
It's about recognizing those exceptions, those companies that might be worth paying a premium for.
So we found our golden goose, bought our shares, we're happily collecting those dividends. Can we just sit back and relax now?
Not so fast. The audiobook really stresses knowing when to sell.
Even if it's a company you love.
Exactly. Even the best companies can face headwinds. They point out some red flags that should make you reassess your holdings. Well, one big one is if a company stops or cuts its dividend.
Makes sense. That's not a good sign.
It could mean they're struggling financially or their priorities have changed.
Okay, so dividend cuts are a no-no. What else?
Another red flag is a major shift in the company's business model. If they suddenly decide to, say, pour all their profits into some risky new venture instead of paying dividends, you might want to rethink your investment.
Right. It's about recognizing when a company might not align with your goals anymore. But what about those external factors? Like, those scary market crashes that seem to happen every few years.
The audiobook tackles those head-on, offering strategies to handle those rough patches.
Okay, I'm listening. What do they suggest?
First and foremost, diversification.
Diversification.
Yes, spread your investments across different companies, different industries, even different regions.
Don't put all your eggs in one basket.
Exactly. By diversifying, you're reducing your exposure to any single company's performance.
Okay, spreading the risk. Got it. But what about the fear of a company going bankrupt and losing everything?
That's where choosing high-quality companies comes in.
Companies that can handle a crisis.
Right. Focus on those established players with a solid track record of weathering economic storms.
What's the survivors?
Exactly. They're less likely to crumble when things get tough.
So it's all about balance, potential reward versus risk.
Yeah.
But even with all the precautions, market crashes can still be scary. How do they suggest dealing with those feelings of fear and uncertainty?
They suggest a mindset shift.
A mindset shift.
Yeah. Instead of seeing a crash as a disaster, see it as an opportunity.
An opportunity.
Buy great companies at a discount.
Okay, turning lemons into lemonade. I like it.
Yeah.
But how do you actually find those dividend-paying gems during a crash when everything's so chaotic?
They offer a few strategies.
Wait.
One is to start with what you know. Think about the products and services you use every day.
Okay.
Chances are a lot of those companies behind those everyday essentials are publicly traded and pay dividends.
So look around you. The answer might be right in front of you.
Right. They also recommend using online stock screeners.
Stock screeners.
Yeah, websites like Google Finance and FinViz have them. They let you filter for companies based on specific criteria like dividend yield, payout ratio, market cap.
So you can kind of create a custom search for dividend stocks.
Exactly. Saves you a ton of time compared to manually researching hundreds of companies.
Sounds much more efficient.
And they even provide a curated list of 36 high-quality dividend-paying companies to get you started.
Wow, that's generous.
That's a great jumping-off point.
But remember, like with Hershey's PE ratio, sometimes you got to bend the rules a bit.
Right. They admit to sometimes straying from their strict PE rule for companies with exceptional growth potential or those unique competitive advantages.
So it's about using the rules as guidelines, but being flexible when it makes sense.
It's about looking at the whole picture, not just focusing on one number.
Okay, that makes sense. It's about using the tools, but also thinking for yourself.
Exactly. And they also emphasize diversification, not just across industries, but geographically, too.
Oh, right. We talked about diversifying companies and sectors, but what about expanding beyond U.S. stocks?
They encourage exploring companies outside the U.S. There are tons of potentially great investments all over the world.
So it's about thinking globally.
Exactly. But they do caution that analyzing international companies can require extra digging.
That's dividing.
Yeah, different countries have different accounting standards, dividend policies, economic landscapes. Plus, you got to consider currency exchange rates.
Right. So it's more complex, but potentially more rewarding.
Right. And they remind us about all the resources out there for investors.
Oh, yeah. Like what?
Websites like Investopedia, Seeking Alpha, FinViz, Morningstar, Google Finance, MSN Money, Yahoo Finance, Guru Focus, Dividend.com. stockcharts.com.
Wow, that's a lot.
They've got you covered. And they end with this really cool metaphor comparing dividend investors to superheroes.
Superheroes. Okay, I'm intrigued.
They talk about dividend investors having the ability to fly through cyberspace, analyzing companies and generating passive income even while they sleep.
Sounds pretty super to me.
Right. They highlight how calm they are during market downturns, their ability to spot opportunities others might miss. It's all about that long-term vision, that discipline.
So it's not just about making money, it's about empowerment.
Exactly. It's about becoming financially independent and achieving your goals.
So are we ready to become dividend superheroes?
We've certainly got the knowledge and the tools to start our journey.
I'm feeling inspired. This whole idea of being a dividend superhero, it really highlights that key takeaway from the audiobook, patience.
Oh, absolutely. Patience and discipline, those are your superpowers in the world of dividend investing.
It's a marathon, not a sprint. Right?
Exactly. It's not about getting rich quick. It's about building wealth slowly and steadily over time.
Like watching that snowball roll and grow.
Exactly. You got to let that compounding do its thing.
The audiobook really encourages tuning out all the noise, the hype, the get-rich-quick schemes.
Right.
It's about finding those solid companies, the ones that pay consistent dividends, and sticking with them.
It's about having a plan, a strategy that matches your goals and your risk tolerance.
This deep dive has been eye-opening. We've learned so much about dividend investing, from those core concepts to real-world examples, even busted a few myths along the way.
Yeah, it's been great.
So what are our key takeaways? Dividends can definitely be a powerful tool, right?
Definitely. They can help you generate passive income, build wealth over the long term.
But it's not a magic bullet, right?
No, it's crucial to approach it strategically, do your research, be patient, stay disciplined.
Don't get emotional. Stick to your plan.
Exactly.
And remember, this is just the beginning.
Right. This audiobook has given us a solid foundation, but the world of investing is constantly changing.
There's always more to learn, new strategies to explore, new opportunities to discover.
Exactly. It's a lifelong journey.
So as we wrap up this deep dive into dividend investing, we want to leave you with this. What other investment strategies or approaches are you curious about? What else do you want to explore on your own investment journey? Keep those questions in mind as you continue learning and growing. The world of finance is full of possibilities. Until next time, happy investing.